Every time the stock market crashes, the same headline appears. Trillions of dollars were wiped out in a single day. Portfolios drop, charts turn red, and it feels like wealth is being destroyed in real time. But there's one uncomfortable question most people never stop to ask. Where did that money actually go? Did it disappear? Did someone take it? Or was it never really there in the first place? Because the truth is, when the market falls, money doesn't simply evaporate, and understanding this changes the way market crashes are seen forever. Welcome to Wealth Logic, where investing concepts are explained in a simple way. But first, a quick disclaimer. This is not financial advice. To understand where the money goes, the stock market has to stop being viewed like a bank vault and start being viewed like a giant high-speed pawn shop. When a headline says the market lost $2 trillion, it doesn't mean someone logged into a central bank and withdrew $2 trillion in cash. It means stock prices fell. When those lower prices are multiplied by the total number of shares, the total market value becomes lower. Think of it like a house. Last year, a realtor might have said the house was worth $500,000. It felt valuable and created the feeling of wealth. But this year, the market cools down, and a new realtor says it's probably worth $450,000. Now, did $50,000 in cash physically leave the bank account? Of course not. Nothing moved. The only thing that changed was the price someone is willing to pay right now. Stocks work the same way. The market is simply an auction. If a company has 10 million shares and the price drops from $100 to $80, the market is said to have lost $200 million. But no one actually removed $200 million from the system. The only thing that changed was investor sentiment. The crowd became fearful and decided the asset being auctioned was no longer worth as much. So if the money is not simply disappearing, who actually gets hurt during a market crash? The answer is simple. Money is only truly lost when the stock is sold. Imagine buying a stock at $100. The market crashes and the price falls to $50. The account suddenly shows a 50% decline. That feels painful, but it is still only a paper loss. No real usable cash has been lost yet because the stock is still owned. Now imagine panic takes over. The headlines create fear, and the stock gets sold at $50. In that moment, the paper loss becomes a real loss. The original $100 investment has now become $50. The loss is locked in, and that money is gone. But this is the part most headlines ignore. For that stock to be sold at $50, someone else had to buy it at $50. While panic sellers rushed to exit, another buyer, possibly a pension fund or a patient investor waiting for this opportunity, stepped in and bought the same stock for half the price it traded at just months earlier. To them, the stock was simply on sale. This is the real story behind a market crash. It's a massive and chaotic wealth transfer machine. Imagine the entire stock market as a crowded room full of people. Suddenly, someone yells, "Fire!" That's the bad news. Panic spreads instantly, and everyone rushes toward the only exit, throwing their valuable jackets and the stocks onto the floor as they run. The people who suffer are the ones who panic and abandon their jackets. The people who benefit are the ones standing calmly near the exit with empty hands and deep pockets. They simply bend down, pick up the jackets for free, and walk away calmly. In reality, buying stocks while everyone else is panicking is not that simple. No one knows if the market will recover or how long recovery might take. Investing always carries risk, which is why staying calm and doing proper research matters. During a crash, money rotates. It moves out of risky assets like stocks and into assets that feel safer in the moment. It flows into cash, it flows into government bonds, it can even flow into tangible assets like gold, which investors tend to trust when confidence in the financial system starts to weaken. So the money that appears to be destroyed is often just sitting on the sidelines in money market accounts, waiting for the panic to fade, waiting to re-enter the market and buy those same stocks at even lower prices. But if the money is only rotating, why do crashes feel so violent and destructive? The answer is a mechanism called forced selling. This is where paper losses can become real losses, even for investors who never wanted to sell. It mainly affects large institutions and over-leveraged traders, people who borrowed money to buy stocks. For example, a hedge fund might buy $1 billion worth of stock while using only $100 million of its own money and borrowing the rest. If the stock price falls too far, the bank that provided the loan becomes nervous. The bank says, "Your collateral is shrinking. You need to provide more cash or the stocks will be sold to recover the money." This is called a margin call. The fund may not want to sell, but it has no choice. That forced selling pushes prices down even further, triggering margin calls for other funds, leading to even more forced selling. It becomes a domino effect that creates a terrifying downward spiral. During this chaos, liquidity dries up and finding a buyer becomes extremely difficult. This is the moment when it truly feels like money is disappearing because the selling pressure becomes completely one-sided. But the money is not actually gone. The buyers are simply hiding, waiting for the downward spiral to stop. The 2008 financial crisis was a perfect example. When Lehman Brothers collapsed, it triggered the ultimate panic moment. The S&P 500 crashed. Headlines reported trillions wiped out. Homeowners were forced to sell, and major banks were forced to sell as well. For ordinary investors holding index funds, portfolio balances in March 2009 looked devastated. The losses on paper were enormous. Anyone who panicked and sold during that period locked those losses into reality, handing stocks over to someone else at the worst possible moment. But on the other side of those trades were investors who understood the cycle. Institutional investors with cash reserves stepped in. Everyday investors who kept their jobs, stayed calm, and continued investing, kept buying while everyone else was rushing to sell. They were picking up the assets abandoned during the panic. Buying the S&P 500 in March 2009 was not just about recovering losses. It positioned investors for one of the strongest bull markets in history. The money was not destroyed in 2008. It was transferred from the panic sellers of 2008 to the patient buyers of 2009. This is the part most people miss. Portfolio value changes every day, but that number is only the market's current auction price, not a bank balance. It represents a paper gain or a paper loss. The real decision is whether to react with panic or patience. When the next market crash arrives and those frightening headlines appear again, the key question becomes simple. Is there enough cash available, and is it possible to do nothing? If the answer is yes, the market's most fearful moments can become its greatest opportunities. And that's all for today. If you enjoyed the video, please like and subscribe to continue growing this community. Thanks for watching, and see you very soon. Bye.